If you're looking to achieve specific financial objectives, consulting an advisor can help you get there sooner. To find out how effective this approach can be, listen to the following story to learn how working with an advisor helped a young couple take important steps toward achieving some of their goals. With a child in their future and a tight budget to navigate, Bob and Judy were looking for advice on how to reduce their debt. Bob, who's 36, and Judy, who's 34, have a combined income of $86,000 per year. Their debts, which include a mortgage, some credit card debt, and a car loan, total $205,000. Their net income each month is $5,950. After paying expenses of $4,570, they are left with $1,380. With their mortgage up for renewal, their advisor recommended they consider an all-in-one banking account, which would allow them to consolidate their debt. From there, they could have their bi-weekly income automatically deposited to this account to reduce their debt, which in turn would lower their monthly interest payments. They could then use these savings to pay down the principal on their house, which could ultimately get them out of debt sooner. With a baby on the way, their advisor also suggested this might be the perfect time for them to reevaluate their personal insurance. He then went on to show them how affordable term insurance can be. In fact, for approximately $45 each month, Bob and Judy could purchase $500,000 and $300,000 of 10-year term insurance respectively. This would cover their mortgage debt if either of them died unexpectedly. If either of them wanted critical illness insurance, a relatively small monthly payment of under $75 could provide them with a $100,000 10-year renewable critical illness policy that would protect them with a one-time payment if one of them were to be diagnosed with and survive the waiting period for one of the covered conditions. The $100,000 would be enough to cover mortgage payments and other expenses. Finally, Bob and Judy's advisor discussed how they could effectively make RRSP or TFSA contributions even with their tight budget. In their case, he recommended that they take advantage of the TFSA's flexibility. A TFSA can be used for retirement savings or for a short-term purchase, and they could replace any funds they withdrew from the account at a later date without penalty. Bob and Judy were able to make some significant steps toward achieving their financial goals, and you can too. If you have specific financial goals in mind and would like to discover ways to achieve them sooner, why not speak to your advisor?